Good morning, everyone, and welcome to another Port Jackson Securities and Fordham Wealth webinar. We're joined here today with Alexander from Barton Gold. Alex, how are you today?
Doing well, thank you.
That's great, Alex. So today's webinar is going to follow the usual trend. Alex is going to do a short presentation. From there, I'll ask a few questions to Alex about the company and dig a little deeper, and then we'll take live questions from the audience. So you have the option to ask questions in the bottom right-hand side of your screen. Feel free to ask those throughout the webinar, and then we'll answer them at the end. We'll endeavour to answer as many as possible, but if we can't get to all of them, feel free to send us an email, and we can pass it on to Alex if we can't answer it ourselves. So Alex, you want to kick us off with a short presentation now?
Yeah, what I'll do is I'll start with essentially an abbreviated version of our IPO presentation. So this is, we'll go through a couple of key slides. This is a document that was published on the 28th of June, which was the date that we started trading on the ASX. So just by way of kind of quick background, and I think everybody can see the screen here, this is actually, our cover image is actually a photo of the open pit Perseverance mine at our Tarcoola project. So give you a bit of an idea of basically what a high quality open pit that is, and it's really just a kernel of the broader Tarcoola project, which we'll get into in great detail. Going into kind of general kind of introductory overview us, really to describe us in a short summary, what Barton Gold is an advanced explorer with prime position in a proven gold, district. And what I'm talking about is actually the Central Gawler Gold Province within the Central Gawler Craton of South Australia. So this is a world-class mineral province. It covers approximately 45% of the surface area of South Australia. So it's a very, very big geological domain within which we've got about 4,700 square kilometers of mining leases and exploration licenses. Now, where we are focused really in the sort of current evolution of the business is on our Tarcoola and our Tunkillia projects. A couple of reasons for that. One, these are two very large scale structures, very large scale projects, and the work that we've done pre-IPO has demonstrated much greater extents and knowledge of these structures than was previously understood. And we are bringing a completely different approach to this region. So one region we're attracted to, South Australia generally, is it's historically been undercompeted from an exploration standpoint. So this region of the Central Gawler Craton has been very, very underexplored for the past 20 years or more. There's really been no systematic modern exploration in this area until we came along and sort of applied a dedicated exploration approach. So during the past 2 years, prior to our IPO, we took perhaps a slightly different approach of actually doing a great deal of technical work to rebase these assets and essentially, let's say, justify, but also fast forward the work that we can do post IPO. So we did ultra high resolution aeromagnetics, we did regional seismic interpretation, test drilling, structural studies, reprocessed a great deal of historical data. And what that did was that identified new large scale structures across Tarcoola. We found an entirely new gold zone right at the edge of that open pit I showed you at the beginning of the presentation. And really major resource extension potential both at Tarcoola and Tunkillia. So in summary, we are an advanced explorer, but we are one that's starting with critical mass. So we're starting with over a 1 million ounce resource base. We also own the only gold mill in the Central Gawler Craton. The end goal for many people is actually our starting point. So 1 million ounces in a mill is usually what people are aiming for. That's what we're starting from. And what we're looking to do is basically take a real leadership role in the Central Gawler Craton and reestablish this as a prominent gold province. So when we sort of dial in on our assets and look at our strategy, what we are looking at here and the reason why we're taking more of a regional exploration focused strategy is that we've really discovered new larger scale potential. So again, that's a product of that pre-IPO work. And at Tarcoola, what that means is we found a new structural model, which has about 14 kilometers of repeat structures, or structures that are very analogous to the structure which created the Perseverance mine, which is the Perseverance shear. At Tunkillia, we've completely remodeled that mineralization. We've identified some higher grade zones within it. We've also identified what we think are some very high priority, significant extension, but also entirely new resource area targets. So we're targeting two large scale mineral systems with very significant discovery potential. And to note again, between these two projects, we're starting with a joint approximately 1 million ounce resource base. And if you look at the image on this slide here, what you can see is we sort of group our projects by Northern Hub and Southern Hub. Northern Hub is essentially a hub or a radius around our central Gawler mill. The Southern Hub is what we might call that exploration hub. So Tarcoola and Tunkillia are only about 70 kilometers apart from one another, and that presents some very interesting opportunities for future development efficiencies and gains, particularly because we believe that both Tarcoola and Tunkillia have the ability to be standalone development projects. So that proximity provides a lot of optionality, and the existence of our current mill also does provide us some optionality if we wanted to start producing from Tarcoola as an earlier stage source of cash flow. The Tarcoola project previously processed through our Challenger, through the mill near our Challenger project, the Central Gawler mill, and that was running at about 94.5% recoveries, so very high performance. So in terms of where are we now, what are we doing? As I mentioned, we've just recently IPO'd on the 28th of June. And one of the key things that maybe sets us apart from many others is we didn't IPO to raise money to figure out what we're doing. Again, we did this work, we knew what our opportunities were, and we started that work immediately. So we have just recently announced the completion of 5,000 meters of drilling at Tarcoola a couple of weeks ago. So that's 5,000 meters of drilling that was completed within 5 weeks of listing. And we are already into another 6,000 meters or so of drilling now at Tunkillia. So very aggressive exploration programs. We're also doing, we have also completed some additional ground penetrating radar over the Tarcoola project, and we're looking at additional programs such as regional gravity surveys to really map out and tackle further detail around structure and stratigraphy. The objective is to be very efficient when we actually start putting holes into those targets. We want to know what we're aiming for so that we have a high hit rate in essence. So when we look at Tarcoola, we have some northern extension targets of the pit. At Tunkillia, we're looking at really large regional structural step out targets. We have been putting out some videos over the past couple of weeks that really give investors an opportunity to actually see these in real life, in real time. Provides a bit more useful context, so I can come back to that for in a little bit. But some of this additional technical work that we're doing really goes to structure, and of course that's really the prevailing theme of exploration. So when we look at Tarcoola, what you can see on the screen here is we've got two tenements, one of which is very, very small, but about 1,200 square kilometers of exploration ground. And this is some of the most interesting ground in the Gawler. We think it's some of the most interesting ground that we've ever worked on professionally. What you can see here from this magnetic image is that a lot of structure going on. So this is right at the heart of the central Gawler craton, right where you have crustal plates coming together and creating a lot of deformation, creating you've got a lot of engine growth in terms of the intrusive bodies which are driving mineralization. And when we look at this ground, one very interesting fact is that we can see here where we have mining lease ML 6455. This little patch was actually the home of the Tarcoola gold rush in the late 1800s and early 1900s. So about 77,000 ounces was produced from this mining lease at a grade of about 37.5 gram per ton between 1900 and 1950 approximately. But this is just a very small portion of this area. This whole area has actually had no exploration drilling on this tenement since 2004, which is really kind of a shocking concept when you consider that this is a known, proven, high-grade gold producing area. So the objective here is to really throw open the doors on Tarcoola as a large-scale, multi-structure, multi-deposit development asset. And when we sort of dial into the sort of the core of it here, when we look at this open pit, and again, this is an inset of the open pit here on the mining lease, and this is a digital schematic of the open pit. One of the really key things here is, this is a relatively small pit. And what you can see from this image is that while the pit was densely drilled from a grade control perspective, there was very, very little drilling around the pit, extensions of the pit and beneath the pit. In fact, the objective of mining this pit was really for the prior owner and operator to subsidize mill feed from another asset. So what ended up happening was that sort of capitalization, if you will, or an exploration budget was diverted towards production. So this area was being essentially underexplored, even though you're looking at very high grade mineralization. This was producing between 4 and 6 grams per ton during 2018. So we have mineralization open in all directions, and you can see here is these blue images are essentially the skin of modeled mineralization. It's not JORC resource, it's just mineralization we've modeled. And when we came in to test this during 2020, we wanted to come in and just get a better understanding of what was going on at various areas around the pit and underneath the pit. One area that we always knew was of interest was this so-called deliverance target. And this is essentially the strike and depth extensions of the Perseverance shear, which is that main controlling structure of the Perseverance mine. So we came in and did some test drilling of this deliverance target, and we drilled it from the west to the east. And in doing that, sort of two things happened. One, we found some very interesting drilling results from the deliverance target. So 2, 3, and 7 meters at between sort of 8 and 30 grams per ton. But we also intercepted structures and mineralization in those same holes at around 30 meters depth. And that resulted in us identifying an entirely new gold zone sitting right at the lip of the open pit. So again, really kind of goes to show just how underexplored this area has been, despite this 130-year history of high-grade gold production from this specific mining lease. When we snap this into sort of a 2D picture, what you can see, and this is a very busy slide, but it's a bit easier to interpret what we're looking at here, is this is a pit. Again, we can see very, very little extensional drilling beneath or as an extension of the original pit design, but a pit shape and an existing pit, which is surrounded by numerous broad and very high grade drilling intercepts. The kind of things that if you found 2 or 3 of these, you'd think you'd be after this aggressively. Again, was not followed up by prior owners due to capital restrictions. So in looking at these assets, we saw that as a fantastic opportunity and really low hanging fruit. And on the left side of the screen here, we've sort of, I don't know, highlighted, sort of the top 10 greatest hits, but very, very impressive drilling intercepts. So these are the sort of Perseverance West and Deliverance Target and Eclipse areas. We have tested those, and we're looking to expand that Perseverance West target at the southwest end of the pit. We've also been drilling at the northeast end of the pit. There was a high-grade chute that stopped in the pit floor here, which was very, very shallow. So we've tested potential depth extensions of that, as well as strike extensions of the open pit in the Lady Racing target. And then off just to the southwest of the pit, we've also tested a new structural target called the Archer target, which we've identified in some of our earlier aeromagnetics and structural assays or structural analyses. So a lot of exciting stuff going on there, a lot of potential to significantly open up this pit, but it really is just the start. And the reason I say that is when we look at the broader data package that we've pulled together, in some cases reprocessing historical data, in some cases applying new data and techniques and technology, we've come up with some very interesting targets across the mining lease. What we can see here are 2 images, one being a magnetic susceptibility image here on the right, and on the left side you can see we've got this high resolution aeromagnetic imagery where we've reprocessed it quite heavily, but this imagery was shot at a density that was essentially 10 times more dense than historical imagery in this area. So we can now start to actually see and discern fine variations in structure throughout this area. And we've identified 3 areas on the mining lease alone that look like they may be analogous to the circumstances that created that Perseverance mine. But then again, to think about this, we are again looking only at this tiny area here, which is the mining lease. And the bigger question is, what's the bigger picture? And the bigger picture is what has got us really excited about this project. And it's one reason why we're so committed to exploration here. When we did a regional seismic reprocessing, we identified an entirely new regional structural model. And we did this prior to coming to IPO. And this work was essentially a game changer for the Tarcoola project. Previously, it was always recognized as an historical high-grade area. It was always recognized that there was high-grade ore in what became the Perseverance mine there at the pit. But nobody had actually done the work to tie together the structure and answer the questions around why is there high-grade mineralization here? Why is it coming to surface in veins here? Why is it embodied here? And in more of a sort of trap, a conglomerate gold trap, where you have this Pila conglomerate structure meeting this perseverance shear. So what we identified was a system, or a sort of a series of repeating faults and shears, both parallel and cross-cutting, that are analogous to the perseverance shear. So what we can see here is that we have this very, very strong Tarcoola basin signature, very highly reflective basin. That's sort of mineralizing rocks in the Tarcoola basin. And these magenta outline shapes, these are the Hiltaba intrusive granite bodies. So these are big intrusive bodies, and they're bringing a source of pressure, they're bringing a source of heat, and they're bringing a source of fluids, which fluids are looking for a pathway to surface. Right here, the sort of third major shear that you can see, that's the perseverance shear, and it comes down through that basin rock, passes by one intrusive body, and plumbs directly into another. And sitting atop that perseverance shear is that high-grade perseverance mine. And what we can see here is we have a dozen or more parallel and cross-cutting structures which pass through that same mineralizing basin rock and plumb into those same intrusive bodies. So that really suggests the potential for a large number, or a system of repeats of that style of mineralization, and the potential for the Tarcoola project to take on a camp scale prospectivity, or camp scale potential, just within a few kilometers of that open pit. And of course, we've got another 1,100 square kilometers of very exciting ground that we're starting to look across. When we go down to Tunkillia, and just for a bit of perspective, again, we're about 70 kilometers southeast of Tarcoola. What we're looking at is an entirely different geological domain, but again, the objective is one and the same. The historical impression of Tunkillia focuses on a very small portion of Tunkillia. So again, we're looking to really establish Tunkillia, step out, if you will, as a major regional scale multi-deposit development asset. When we think about the mineralization that we have there, when we talk about our 965,000 ounce resource, that's the 223 deposit, and that resides in the northwest corner of our tenement package here. Now, a couple of interesting things. That 965,000 ounces lies within strike that's about 2.5 kilometers long. But on this tenement alone, we've got about 30 kilometers of strike on the Jarlbrinde shear zone. So that 2.5 kilometers of mineralization sits within about 15 kilometers of map structure, which is known to be sort of geologically, geophysically, and geochemically continuous from the outer parameters of that deposit. So we see real potential for significant extension, but also repeats of that mineralization. This is essentially analogous to sort of the major Kalgoorlie style shear zone systems. So we think that deposit is essentially just the tip of the iceberg. One of the reasons for that is that there was a lot of historical, very shallow pathfinder drilling that was done back in the 1990s. And again, one of the great misconceptions about Tunkillia is that it's been worked hard, or that it has been explored widely. What you see on this image before you here, this magenta outline, that is the trace outline of the 223 deposit. So that's your 965,000 ounces, about 2.5 kilometers long. And what we're looking at here is about an 8 kilometer diagonal on the northern portion of that Jarlbrinde shear zone. And across this project area, there was a lot of very shallow RAB drilling done to basically identify prospective mineralization. And to put this in context, our total drilling database up until this drilling program we're doing now is about 285,000 meters. But the average drill hole depth is only about 77 meters. And that includes all of the much deeper holes that were drilled in the 223 deposit to convert that to a JORC resource. So, the mathematical conclusion is actually that basically all of these drill holes that were drilled through this area were much shallower. In fact, most of them were only about 40, 45, 50 meters depth. And this is an area where you have anywhere between 20, 30, 40, 50 meters of cover. So when we look at this image, we can see here, and all of these circles are high-grade drill holes. So these aren't soil geochem analyses. These are high-grade drilling results. This drilling passed just through the cover, picked up very interesting mineralization, and stopped. And since the year 2000, the vast majority, over 90% of all drilling in this region, has gone into just infilling the 223 deposit to convert that to a resource. So what we have are hundreds and thousands of drill holes that provide a very high value roadmap to us for pre-existing, predefined mineralized targets that allows us to get after those very selectively, start to sort of model the potential that's there. Of course, we've done a very detailed target ranking. And what we are looking at now with our drilling is targeting some significant offset extensions of the 223 deposit. So key thing is, we're not looking at nibbling at the edges of the existing deposit. We are interested in significant extents, significant resource additions. So we are looking at this area up here, which is tagged the Centurion area. We just call it 223 North. But we are testing the theory that there may be an offset of the sort of mineralized pattern that we think constitutes the core of the 223 deposit. So we're drilling up here to test quite a significant extent of that potential sort of regional extension of mineralization. And we're also testing a potential offset of that mineralization about 1 kilometer to the south. So we're stepping out 1 to 2 kilometers to the north and about 1 kilometer to the south. So very meaningful results if those come back positive. We're also stepping out even more regionally to this area that's called Area 51. So this is about 4 kilometers northwest of the 223 deposit. And if that is a successful program, that might look like a completely independent body of mineralization onto which we can continue to build. So it's very exciting, right? And basically what that shows us that, again, here, we're looking at several kilometers of mineralized strike that we might be able to convert into actual mineralized bodies in JORC resource. If the potential is that 2.5 kilometers hosts almost 1 million ounces, what's the potential that another 5 to 8 kilometers of mineralized strike? What's the potential that can be hosted there? We think this has the potential to become a multi-million ounce development camp in its own right. But again, I use the tip of the iceberg analogy. That area that we're looking at is just this area here. In fact, the 223 deposit is this tiny little area where the cursor is, where I've got the cursor over the image. This is that whole area we are looking at there, and we've got another 25 kilometers to the south on this same structure. So real potential for district scale exploration, district scale discovery, but also district scale development. So we're pretty excited about this. Again, we see real multi-million ounce potential and the ability for this to be a cornerstone development asset for Barton Gold. Just a quick note on our northern hub. As I think you're aware, we do own a mill up in our project areas. So we do own the historical Challenger underground mine. We also own the mill that's on the same tenement package. So the Central Gawler mill is about a 650,000 ton per annum mill. We do have an expansion option on that. It's currently on care and maintenance, but has historically run very efficiently. So historical recovery is about 94.5%, and we can return that to operations with fairly limited refurbishment costs. What's interesting, of course, is we do have some minority interests in joint venture ground around us. That's currently being consolidated by Marmota Limited. They also have a very interesting project called Aurora Tank. It's about 50 kilometers east-northeast of our mill. Now, they haven't yet put a resource on that, but they're actually diamond drilling right now to bring it to resource and reserve status so they can apply for a mining lease. On the joint venture ground that we do have a minority interest in, there's about 319,000 ounces of gold. Relatively lower grade, but there are some higher grade components that could be mined, and that's all within 40 kilometers of the mill. So there's real potential to look at essentially recasting the future of this northern hub as some sort of a consolidated operator, while also focusing on large scale discovery and development potential in our southern hub. So that's really a good sort of quick summary of the assets and the overview. I think the real questions, of course, which come up is sort of what's next. We are more than halfway through, about 11,000 meters of drilling. That should be completed by mid-September. And of course, we having completed our drilling at Tarcoola and now being into Tunkillia, we would be expecting a pretty steady stream of gold assay results starting from early September running all the way through November. So those, in addition to the results of our ground penetrating radar, we're also looking at starting some regional gravity surveys of over some of our more exciting ground at Tarcoola. That is actually also being co-funded by the South Australian government, so we've got a lot of support there. This all sort of adds up to, I think, quite a high degree of news flow starting very, very soon, and from targets where we understand these opportunities very well. And I think be fair to say we're pretty excited about what we think will come out of them. So we'll integrate that. We'll integrate all that data. We'll integrate all that drilling, and then we'll get back out into additional drilling once we have these results. So our plan is to, again, we're starting big. We're aiming big. We've kicked off work. We're going to keep busy, and I think that gives us the opportunity to really stand out, not only in terms of our ability to commit to and execute large-scale programs, but also in terms of being a fairly uniquely South Australia-focused gold explorer and developer.
Thanks for that, Sam. It's pretty impressive to have only floated a couple of months ago and already have so much to say and so much in the pipeline for a company that's, I guess, in many ways in its infant stage on the ASX. But as you've spoken about, it's done very well already in terms of building the resource. So from here, I'm just going to ask Sam a few questions, and as I do so, please feel free to ask some questions as we go. We've got a few coming in at the moment. We'll go through those at the end. So just quickly, Sam, in terms of how did you originally see South Australia and as an area you guys wanted to focus your efforts in?
So I think one of the key things about South Australia, and I touched upon it briefly, is that it is a very richly mineralized geological domain. I think, you know, probably everybody who's interested in this webinar has heard of Olympic Dam, right? So that's about 225 kilometers east of us on the eastern margins of the Gawler Craton. There's an incredible amount going on there. It is one of the few places that is so richly endowed and yet so thinly explored. So that was a really good opportunity to look at one, essentially getting into an area and not only having one perhaps high exploration prospectivity and true scale remaining untapped discovery potential, but one where we could actually get in and consolidate a really strong position, which would allow us to essentially consolidate the future and take a leadership role in that area. So the potential is discovery, the potential is development, the potential is rejuvenating an area that essentially sort of fell out of favor and has sort of dwindled and sort of died down economically for a long time. And of course, one thing that's very important is government support. So we've gotten a very, very high level of government support. We consulted with the government before going in. It's a great jurisdiction. They're very flexible. They're very supportive. They are, you know, interested to boost mining in South Australia and attract investment to Australia. So they've been really fantastic in sort of helping us navigate the what ifs and what abouts of entering South Australia and making sure that we can establish ourselves there very efficiently and start to work very effectively. So it's a very good environment, South Australia. And it's one where you can actually have a bit more of a personal relationship with the government, which is of course very, very helpful when you're trying to think about, well, you know, this is a business run by people, managed by people. We exist in a market run by human psychology, and we have to deal with people to get things done. It makes it a lot easier to sort of chart your way to the future and aim for your end objectives and know what you need to do along the way and actually have that kind of interface to get there.
And that interface has really been proven, you know, in the last month or so when that funding came through. So it's really good to see that those relationships being built well with the South Australian government.
Yeah.
And then just quickly in relation to, you know, the listing of the company, how have you adapted from being, you know, privately listed before to now being publicly listed?
Good question. Look, I think in terms of going from private to public, of course, you pick up some statutory obligations. You pick up additional disclosure obligations that are really codified in the rules, if you will. But for a very long time prior to being listed, we essentially practiced or acted as though we were listed. So we were very, very frequently providing people detailed updates. The difference I would say now is that, you know, the precise format in which you need to provide that update is very specific. But we've of course evolved our team, we've evolved our corporate governance to essentially codify and formalize things, you know, our corporate governance practices. And we just sort of formalized the reporting of that, which of course is a statutory obligation, both for ASIC and ASX. So it's been a very small, I think, shift in mindset for us. It's just a slight reorganization of how we go and execute these sort of communications and reporting.
No, that's great to hear. And just briefly in the webinar, you spoke about you listed not to raise money because you already have the resource sitting there in such a large capacity already. So what was the main motivation to actually listing the company?
Well, look, I think you sort of get to a point with a company where it either needs to focus on full-scale development in a private sense or full-scale development in a public sense. And once you get to a certain point where you need to spend a certain amount of capital, there's a natural attraction to the public markets. You can get a lot more people following your story. You can access capital, let's say, more easily, but with greater fluidity once you are listed. In the private markets, you obviously have to sort of battle the visibility battle, and you also have to raise ever larger and larger amounts of money. So it's hard to get the valuation of your assets or the recognition of your assets in the private market the same way you can in the public market. We also want this to become a company that is sort of a living representation of sort of excellence in gold exploration, gold development, and gold operations in South Australia. That's really our goal, is to establish ourselves as the South Australian gold exploration, development, and mining company. So taking all those things together, we really felt that the public market was the correct place to be. Despite the fact that it's been a very, very volatile market, particularly in gold securities, which I'm sure all of your viewers will know, we made the decision that it was really, the best time is essentially bite the bullet, go out on an attractive valuation, raise a very good amount of capital, and apply that to a very solid plan. So we know what our opportunities are. We raised a lot of capital to make sure we could pursue them aggressively, and that gives us plenty of runway. So we don't have to worry about sitting around for 6 months to figure out what we're doing, and then drill a few thousand meters, and then interpret, and drill a few thousand meters and interpret, and then go back to the market for money. We can go hell for leather, so to speak, for two years straight with our exploration plan and not have to come back to the market.
Okay, that's great to hear. So it's a matter of the long-term capital that was built up to take advantage of your current position, rather than having that short-term capital to actually find a large enough resource to continue to raise money, and alongside the publicity element as well.
We did, with, for example, that 1 million ounce resource base to which I was referring, we actually published an updated resource before we even filed our prospectus. So that 965,000 ounce resource was originally about 550. So we upgraded and extended the resource. We just wanted to get everything set, make sure we've got a very, very strong set of foundations, both in terms of people, both in terms of assets, infrastructure, and then of course exploration potential. So the idea was to kind of bring as much of the proof in the pudding forward, and then justify raising a large amount of capital rather than raise a smaller amount of capital and have to go piecemeal.
Yeah, no, understandable. And then you've just spoken then about being able to go hell for leather for 2 years and with your drilling. Is that just sort of based on the cash position allows you to go 2 years before you'd need to raise more capital?
Correct. Yeah. So what we've modeled is, and as you must with a prospectus, you have to sort of set out your 2-year plan with your prospectus, and of course the ASX wants to see people essentially ensuring through their capital event through an IPO that they are capitalized or able to function for 2 years. A lot of companies come to market and raise a smaller amount of money, and what that means is they have to downscale the amount of exploration they're doing during that 2-year period. From our standpoint, we looked at our assets, and we really are spoiled for choice in terms of high priority targets. Your typical target ranking exercise is you might have 10 targets and 3 of them become very high priority. We have probably 60 targets and 20 of them are very high priority. So for us, we were very comfortable committing ourselves to spending a lot more capital because of the amount of work that we had done using different technologies to sort of triangulate and sort of cross-reference and be sure that we dialed in on that work, dialed in on where we're going to be exploring. And we're also doing additional technical work. That's where the ground penetrating radar and regional gravity surveys come in. Those, in conjunction with our aeromagnetics, that very high resolution imagery that we shot in March last year, that should allow us to target things much more precisely. So when we say we're planning to spend $1 million drilling on a target, we're not sort of doing that wildcat pattern drilling style of search, explore by drill. We're actually targeting structures with a drill, so that we should hopefully have a higher hit rate and a preponderance of positive results based upon all of the data that we've reviewed, both historical and modern.
Just on those, so the radar surveys, and you're talking about the gravity surveys as well, how accurate have they been for you in the past? And is there any sort of further way to validate those? As you call yourself, I guess, an advanced explorer, so using different techniques that you're using?
Yeah. So I'll take you back to one image here when we think about the ground penetrating radar. So really what we want to do with our exploration methodologies, and of course I should point out, I'm not a geologist. I am essentially an economist and a financier. We work with very, very talented geologists and geophysicists. But what we're trying to do is find multiple points of validation before we commit major capital. So we don't want to have one reference source that suggests something may be an interesting target and then commit a large amount of capital and drill that and either, aim poorly and miss significantly or just miss altogether. So by adding things like ground penetrating radar, we're overlaying that with a theory that we've already developed. In the case of Tarcoola, again, we have this ultra high resolution aeromagnetic survey that we did, and we also have this interpreted 3D regional model. So we can overlay this interpreted 3D regional model in great detail with this aeromagnetic imagery where we can start to see the outlines and breaks in structure and things that are suggestive of potential mineralizing structures. And when we come across this area, the ground penetrating radar that we've done covers this sort of highest priority area around the Perseverance mine and this sort of target 1 area. That's designed to sort of look at this from the top down to get a much more refined eye on finer structures in that top 100 meters. The reason being that we then have essentially 3 data sets, 3 physical or geophysical data sets that we can also then cross-reference with historical drill holes, identify what we think are the highest priority targets and highest likelihood of precise structures that might yield the best outcomes. And then we can go and take 1 shot as opposed to taking 60 shots trying to find that structure. And the difference is spending $200,000 versus spending $2 million. So we're really trying to lead our results through efficiency, and we're trying to lead efficiency through the use of newer technology that's not been applied in this region before. Ground penetrating radar is one of those. In terms of regional gravity, what we have found in this region, in this terrain, is that the combination of gravity plus aeromagnetics is actually the best combination to map out structure and stratigraphy. So if we use, if you're looking for copper, you might use electromagnetic, right? Because you're trying to pick up a very highly conductive signature. But we're not hunting in that same kind of geology. So we're looking for different signatures. We're looking for structurally driven trends. And so being able to identify structure rather than conductivity is more valuable to us. And in this area, that gravity plus aeromag has been very, very helpful.
Sure. So it's a matter of doing as much as you can before you put the drill in to make sure you have the highest likelihood of success moving forward.
Absolutely. Yeah. And hopefully a higher hit rate on the best targets that you've continuously re-ranked and reprioritized based upon all the data you know, going all the way back to historical drill holes and geochem as well.
Okay. And just moving forward now, considering the other explorers in the region, such as Renascor Resources and Indiana Resources, what's your competitive advantage against them?
Look, I mean, there are some fine companies. They've got some good people and they've got some very interesting ground. I think the advantages that we have are probably a couple. One, again, I think we've done more background work to basically understand our opportunity set. So we know what our opportunities are, and the work that we've done demonstrates that they are very, very large opportunities. We're not just focusing in on one specific target and building out from there. We're actually looking at a much larger grid of priorities. So I think the potential is for us to expand these projects out considerably to a much greater degree and much faster. We are, of course, very well capitalized. So we are able to tackle programs aggressively. We are able to undertake large work programs rather than having to break them down and do successive rounds of funding and work. And I think when you boil it down to the sort of foundational assets that we have, we also have a great team. We have a technical team and we have a board that is very forward-facing. So we have a very, very experienced team, very forward-facing. It essentially reflects our ambitions to move into development and operation of our assets. That coupled with a very strong infrastructure base and a very strong resource base. I mean, we have, in one sense, the center of gravity in the central Gawler Creighton when it comes to infrastructure. We own the only mill in the region. On the other hand, we also have the center of gravity when it comes to mineral resources. We have far and away the largest gold resources in the region. So we've got these two very strong bases that we can build on and leverage. And it means that while we intend to do a very great amount with our capital, we have in some ways smaller hurdles to jump to get to those next stages of commercialization. We can leverage an existing plant to existing mineralization without spending $80 to $100 million to get it into operations. We can leverage Tunkillia into a multi-million ounce deposit starting from around 1 million ounces instead of starting from 0. So it's a little bit of a head start and a little bit of a scale perspective, both in terms of the assets themselves and also the capitalization and planning we've got behind that capitalization.
Yeah, the mill really puts you in a position to be ahead of the game in so many ways, especially with the amount of money they cost to put there. So it's positive to see that. That's for sure.
Yeah.
And just finally,
free option on mineralization. Yeah.
Yeah, definitely. And just finally, before we go to live questions, I'll just ask one more. So I understand at the moment there's a bit of a labour shortage in the market with regards to drill rigs. Are you guys being affected by that at all at the moment?
We're not. It is something that we have seen. All of us have some, historical or existing, involvements in observation of other companies and other jurisdictions in Australia. It's something that we have seen affecting quite a number of our peers. I think the Western Australian peers are in particular suffering. You've had a sort of the everything boom, and WA being so driven by commodity production, a huge amount of the labor base that's there has been sucked out very aggressively into all of these different projects. And that manifests in a couple of different ways. One is, availability of people, which is a really big problem. And then of course costs, because the cost of people to compete for them is going up. But then you also see sort of lagged and follow-on effects where you've got explorers who are now waiting 3 to 4 months for assay results. So that is something that is at once sort of an endemic problem in the industry right now, but it's something that we've been able to navigate fairly well. Again, I think it comes down to, one, focusing on our competitive advantage and presence in South Australia. There's a very good group of people in South Australia with a long history of exploration and production expertise in South Australia, and they like to stay in South Australia. So we've got a high availability of people. And in terms of our service providers, we've built a very positive relationship with them over the past 2 years and more. So, this is not the first time we've used our drilling contractor. This is not the first time we've used our geology consultants. This is not the first time we've used our in-field exploration fieldies and field hands. We have already a long-standing relationship in the community, as it were. We've built strong relationships with our service providers. So we have been able to get those services on, I think, an expedited basis and a prioritized basis, and that's been very helpful to us.
Okay, it's good to hear that the South Australians like to stay put. They don't want to move out, and so that benefits you guys quite well then.
Well, everybody, I think people have their home, and a big component of the mining industry is fly in, fly out, and that's true whether it's remote operations or, in the case of Western Australian operations, people flying in and flying out just for not so remote work. So people have an opportunity to stay in their home state where their families are, shorten their commutes, have perhaps a more relaxed experience. I think people are quite eager for that. And of course, it'd be fair to note, we're not competing for 300 people at the moment. We have, perhaps 10 or more people on our work sites at a time when you consider the drilling crew and our geology team and our care and maintenance team. So we're not yet up against, and perhaps fortuitously, we're not up against the labor market to really compete for that supply of labor resources. We have the good fortune of sort of being in exploration while everybody else is having trouble being in operations.
Yeah, no, definitely. We'll just move to live questions from the floor now. So I'll just start with David. So you touched on it briefly, but if you just give a little bit more background to it, would be good. So David's just asked, do you have any further understanding of the grade of gold you could find in your exploration?
Yeah, so obviously when we talk about Tarcoola and Tunkillia, we're looking at two very different sort of geological setups, right? So, and I'll take us back into the presentation here, but what we see at Tarcoola is a much more structurally complex terrain. And again, we can see that in this image here. This is a lot of crisscrossing, cross-cutting faulting and structures, a lot of deformation and folding and faulting. So what we tend to find in Tarcoola are very prominent and high-grade veins rather than large-scale disseminated mineralization. So again, looking across, sort of history and looking again, when we think about the mining lease, along the mining lease, there's a ridge, and along that ridge, you can see dozens of old veins that come straight to surface where people mined into a vein that's about 1 meter wide and they're mining 20, 30, 40, 50 gram per ton. Then we also have rheological gold traps where you have these vein structures, these shear structures hitting a conglomerate feature, and the gold blows out into a rheological trap. And that is what formed this very, very rich portion of the Perseverance mine here. So this was sort of the richest area of that operation because there's a gold trap that was created by a release of pressure into a conglomerate formation. So there's a lot more structure and structural complexity to understand at Tarcoola. But again, when we look at what we have here in terms of exploration results, we have intercepts of anywhere between sort of 2, 3, and 10 meters at anything from 6 to 60 grams per ton. So what we're looking for at Tarcoola and what we expect to find at Tarcoola is more of that tightly defined high-grade open pittable and underground mineralization. And when we think about Tunkillia, again, we are in one of these sort of large-scale shear-hosted mineralized setups where you have very long, very consistent demagnetized zones on both the eastern and western margin of that shear zone. So that's really that much more sort of larger scale, broader bodies of mineralization. And when we look at Tunkillia, what we see is instead of 2 meters of mineralization, we see 30, 40, 50, 80 meter widths of mineralization of between sort of 1 and 1.5 gram per ton on average. So something that you can drive an 8-lane highway through. So very, very different setups. And I think that provides a pretty interesting opportunity because we can flex our development preferences to suit what is either best for the market, but also we've got optionality inside these assets in terms of what type of development we want to do. We have different types of mineralization, and if we do develop the southern hub as a joint hub, what will probably end up happening is having a new mill at Tunkillia. That's a large bulk, low-grade operation. And then supplementing that with more selectively mined open pit and underground high-grade ore from Tarcoola.
Sure, and just for some of the viewers who might not understand, could you just give a brief summary of what higher grade gold means compared to lower grade gold?
Yeah, so when we think about the Tarcoola project, that Perseverance mine was producing between 4 and 6 gram per ton to the mill during 2018. That is a very high-grade open pit. A traditional open pit operation would be attractive between sort of 2 to 3 gram per ton would be an attractive operation. And today in modern bulk mining, we see open pit operations going down sub 1 gram per ton. Evolution Mining, for example, have the Mount Rodden property where their forward mining reserves are 0.3 gram per ton and less. They've just become very, very good at bulk operations. Regis Resources, for example, essentially runs their entire business producing, I believe now, well over 300,000 ounces per annum on 1 gram per ton mineralization. So when we look at lower grade mineralization, that's what we're talking about when we say that sort of 1 gram per ton range. And then you have the potential for sort of intermediate grades anywhere between that sort of 1 to 5 gram per ton. In the higher grade style projects, you'll see sort of higher peaks and spikes of grade. And in various different zones, and then in these sort of larger scale disseminated, which means the gold sort of percolated out and spread out in the mineralization, you'll tend to see more consistent grades throughout the resource body. At Tunkillia, we actually have found high-grade zones within the resource body, but by and large, the vast majority of the resource is that sort of consistent, broad, steady grade. So you would mine that in more of a bulk open pit, low-cost operation.
Sure. No, thanks for giving some more insight into the grade of gold. And then I've got a question here from Reese. So Reese has just asked, what is the best case scenario for gold, for Barton Gold?
For Barton Gold. Look, I'll take you back to our development slide here. So again, we've got essentially 2 development hubs, and I think a best case scenario is you see both of these commercialized. So if we kind of work backwards and say, what does that mean? It means in the northern hub, finding a way to either combine existing mineralization or new mineralization with that infrastructure, basically exercising that free infrastructure option. And in the southern hub, best case scenario is sort of what we see as the real potential of Tarcoola and Tunkillia, and that is both of them becoming standalone developable projects. So standalone capable projects that you do actually develop with independent mills for increased efficiency and increased production, or as a single combined hub. That would give us essentially 2 mills that are almost exactly 200 kilometers apart, and then instead of 1 but 2 operating gold mills, which are the only gold mills in that region. And that would really allow us to look at sort of the next 10, 20, and 30 years. How do we further consolidate this region? How do we further expedite broader regional exploration and development by starting to absorb that surrounding area, consolidate that area, whether in terms of joint ventures, whether in terms of acquisitions, or just acquiring the economics through toll milling or purchase of ore. So we think we've got a very strong foundation to build an even stronger foundation, a 2 mill, two or three operation company, producing well over 100,000 ounces, and being having a clear pathway to becoming a sort of Australian mid-tier competitor, targeting 250,000 ounces per annum. I think that would be an excellent outcome for our objectives, and I think it's supported by the asset base that we have, assuming that we use our resources well and that our theses prove up in exploration.
Sure. No, it's a very good understanding of where the company could be, and obviously things have to go right along the way, but it's always good to see the end goal throughout that process. Moving on to Fiona's question now. So Fiona says, as an economist, so referring to you there, Alex, where do you see the price of gold moving forward?
Good, very good question. I think in really short terms, I see the gold price going up on a long-term horizon. And the reason for that is that we are in a very unique scenario. We're talking, people are talking a lot now about inflation, and inflation is starting to be an actual point of discussion after, perhaps the last 18 months of saying, oh, no, inflation's not real, it's transitory, don't worry, it goes away, whatever. My view, kind of looking back across history and sort of really just looking at essentially behavioral economics, how people behave, and in particular, how certain people behave, and I'll come to that in a second. My view is that we probably are looking at the biggest macro setup for gold in multiple generations. And the reason is that when we think of gold, we think of essentially 2 things. 1, jewelry demand, and 2, investment demand. And that investment demand is sort of traditionally focused on being an inflation hedge, or security, essentially security against monetary debasement, right? The government can trash my bank account, but they can't take my gold, kind of a thing. So we've entered a quite a scary new world where inflation is not new, but there's been a real structural shift in the key drivers of inflation. And there has now been, over the past 18 months, an increased focus in the market on the amount of money that's been printed by Federal Reserves and central banks around the world during the past 18 months. But the reality is that problem started a long time ago, not in January, February, and March 2020 when COVID really took hold. We can look back to the GFC and see that sort of past is prologue in many ways. Now, I've actually got an image here. I've got some other materials I'll bring up. I gave a presentation to a Pakistani investment bank last year. And for a bit of background, Pakistan is actually the 4th largest retail gold market in the world. And this is a slide that I prepared for that discussion. But what we've seen in terms of when I talk about the structural shift in Western economies is a shift to essentially free money policies. So when we had the GFC, we have this thing called the money supply, right? And that's defined as M1 or M2. In some cases, people refer to M3 money supply, but it's basically how much money is in the system and how much money is in deposit accounts and how much is circulating around. So when the GFC hit, we basically had a monetary policy response, which everybody started referring to as quantitative easing, and that was shortened to QE1 because we had to start talking about QE2, and then now we're talking about QE3 and QE4. And the point is that during the GFC, major Western economies, for the first time in history, sampled this sort of free money policy. There was this original $700 billion bailout of banks, and then there was another trillion, and another trillion, another trillion. And what we can see during the period of this sort of the GFC policy response, which was early 2009 to the end of 2012, the money supply, and I've got the M2 money stock here, basically went up by about 50% in M2 terms. But from 2012 onward, and I should mention during that time, the gold price went from $900 to $1,900 US per ounce. So gold caught up and started to recognize what was going on in terms of people evaluating risk and recognizing this printing. But once we got through the GFC, once markets started recovering, equities markets started booming again from kind of March 2012 and getting into the end of 2012, and everybody started to sort of take their eye off the ball. What you can see is that looking at the money stock here, the government just didn't stop printing money. Essentially, they thought, well, this is going really, really well. Markets are booming. Housing markets are booming again. Nobody's looking. We'll just keep printing. And what's happened is we arrive at early 2020, and we have a real enemy banging on our door in the form of COVID. We have economic crisis. We have a scared world. We have dramatic declines in consumer, in retail consumption, which is 50 to 70% of the GDP of most Western nations. It's a consumer-driven economy. And arriving at this great problem, we already have 1% interest rates. Essentially, during this sort of free money, good time, nobody's looking policy, we have fired all of our monetary policy arrows, all of our stimulus ability at an enemy which doesn't exist. All our arrows are now stuck out in the field, and we've got a real enemy coming to burn down the castle. And so the response has been to quintuple down on the printing. And when we put this in context, this has never been done before in Western economies. If I take you to the M1 money stock of the United States, so this is some great data that anybody can access. This is data that's published by the St. Louis Federal Reserve. This is the M1 money stock from 1960 to 2021, right? So M1 money stock is essentially currency outside of the US Treasury, the Federal Reserve, and deposit vaults. So money that's in the system, short any additional derivatives of it. And at the beginning of 2020, the M1 money stock was about $4 trillion, and it's currently over $19 trillion. So inside of 18 months, the US M1 money stock has quadrupled. But if we look at the broader context of what's happened, again, looking at that post-GFC money supply, even between the GFC and 2020, there was such an increase in the money stock. The current money stock is 11.5 times the post-GFC money stock. So governments have borrowed heavily to facilitate this. They have lent heavily to facilitate this. And they're now telling us, well, don't worry, inflation is transitory. Well, we're seeing consumer prices and raw input prices jumping dramatically. In fact, we now have 5% year-over-year inflation. That's only happened a couple of times in the last 20 years. They're telling us it's transitory, but that could only be true if the government could, A, pay back that debt, or B, remove all this money from the system so that it doesn't continue to go in circles and drive up asset prices. Now, I would put the simple question to you: how do you put $15 trillion into an economy in a period of 18 months and then pull it out without destroying that entire economy? You can't, right? It took the amount of money they've printed in the past 18 months has never existed in all of US monetary history. So the government is stuck in the same debt trap. They're running a massive deficit. They can't pay back the debt, so they also can't allow interest rates to go up. They've printed all this money they can't pull out of the market. And at the end of the day, and I did reference this, a lot of this is about behavioral economics and a certain class or the behavior of a certain group of people, and that is politicians. So politicians the world over, there's one thing that unites them, and that's, broadly speaking, a very short-term game. They have a 2 to 4 year re-election incentive, and short-term players, as a rule, generally do not make long-term plans, but they do cause long-term effects. And that, I think, when we look at the newfound comfort with printing and trying to invent all of these crazy explanations like modern monetary policy about how it's all going to be okay because we can print forever. I mean, we do have an example of what it looks like when you adopt a print forever policy. It's called Zimbabwe. It doesn't work. So the real issue here is that, you know, there's an attempt to essentially give you cake today, but take it out of, you know, your entire future by inflating and debasing your currency so badly. And I think it's one thing that people really need to wake up to. I think it's something that people are starting to wake up to. Again, now you're starting to see institutional investors thinking about allocating 5 to 10% of their portfolios into gold. You're seeing, you know, $100 trillion bond markets going to zero yields, looking for alternative opportunities. I mean, gold equities are yielding more than bonds right now. At what point does a couple $1 trillion of capital flows come into the gold market, which would expand the gold market by a factor of 2 to 3, 4 times? So the potential there is for us to finally hit that sort of blow off point where, you know, panic or institutional adoption actually set in, and you see a return to investment in real assets and inflation hedge assets like, well, properties, but also gold. Yeah, it's a very big topic. It's a very big topic, and I've probably gone a bit too far with it. But I think one of the key things, and a really good analogy that we can use here, though I've probably thrown a few of those out there, is that, you know, when we think about the battery metals transition that we're seeing, right? So batteries are transforming the auto and the metal economies structurally. Nickel is now all of a sudden for more than stainless steel, right? This new free money, endless printing mentality that Western politicians have adopted now for the first time in history is also going to transform the inflation economy, if you will. And I don't know if we can get the genie back in the bottle, because I don't know how you pull this kind of capital out of the market. Prices that have gone up are going to be sticky. They're not going to come back down. Even if inflation drops back down to 2%, we've still had a structural step in prices, which means for all time in the future, prices are going to be structurally higher than they would have been if we didn't have this inflation. So it's incredibly damaging, not only today, but for the future. You know, if you have 2% inflation, the value of your dollar today is cut by 50% in 35 years. If you have 5% inflation, which is probably closer to the true underlying rate of inflation once you factor home prices, then the value of your dollar is cut in half in 15 years. And if you start to factor taxes, which are not included in inflation indices, and credit Rick Rule gave a great summary of this at a recent gold conference I attended. You know, when you sort of start to factor taxes, taxes on income, you know, what is your true consumer price index? You know, what is your true purchasing power? Taxes almost never decrease. The government finds a new way to tax a new thing all the time. You know, is your real inflation rate somewhere closer to 10%? Because if it is, then the value of your dollar is cut in half in 7 years. And in 35 years, instead of having 50 cents, you're going to have 4 cents. So it's really a scary thing that we're embarking on, and we have The only examples and analogs that we have in history are very scary. It's Weimar Republic, Germany, and Zimbabwe, basically. Neither one of those were good outcomes.
Thanks for that, Alex. It's probably the most informed view of the gold price from any director or CEO of a gold company I've spoken with for quite a while. And it's good to see that your background in finance and economics has given you that understanding. Just before we head off, I might just ask one more question. It is in some ways in relation to this and what you've been speaking about just now. A question here from Leon. He's asked, do you hedge against gold prices, and would you consider doing so moving forward?
Very good question. It's something that we do think about a lot. So yeah, from a finance and structuring standpoint, we definitely would think about hedging gold prices. We probably wouldn't do it at the current moment. The reason being that you would have to incur a premium for a premium which is designed to hedge your ability to realize that value. Now, until we're in operations, we are not seeking to realize or extract an actual value or convert an ounce in the ground into an ounce into a bank account, at which point you're really concerned about making sure you're hedging that price so that you can actually forecast your operations, your costs, your margins, and track these things, and essentially finance your project on what is hopefully a reliable forecast and essentially a stable revenue forecast. As we move forward and as we get into, hopefully much larger resources and then convert those into reserves with feasibility studies, and we start thinking about development, when we start thinking about taking on that large risk that we need to balance, being large scale financing, funding, development risk, we would certainly be looking at hedging a component of our forward gold sales to make sure that we're de-risking that finance component. There are some producing companies that run completely unhedged to the gold price, and some of them, for example, I think Evolution Mining doesn't do very much hedging, if at all, but they very, very conservatively model their operations. So they model their operations and forecast and do resources and reserves on prices that are a very large discount to the current price. So they always have kind of room for upside in their performance, pre-built in through conservatism in their modeling. That's another way to approach it, but it's a little bit harder for young or smaller companies to do because we don't already have that sort of cash flow backing behind us. We have to sort of show people the full picture of the what if based upon current resource prices and then hedge that.
Sure. Well, thanks for answering that at the end just now. Just before we head off, is there any sort of final remarks you'd like to leave with investors as we move into, I guess, an interesting 6 months of drilling or so?
Yeah, look, obviously we're very excited about what we're doing. Again, we've done a huge amount of work coming to where we are. We understand our opportunities, and we can see very clearly that those opportunities are very, very large. So we're starting with that critical mass. We are well funded to seek to considerably expand that critical mass, and we're doing this in a proven region. So, poorly explored region, we've got great funding, we've got great government support, we have got a great team, we've got huge opportunities, and I think really importantly, and perhaps it all comes down to this, is we've been able to demonstrate coming out of the gates immediately post IPO and into a very difficult exploration market because of all these sort of COVID difficulties and labor demand and service demand difficulties. We have demonstrated and proven our ability to execute, and that really is everything. Being able to execute on time, on budget, and on plan is really everything when it comes to efficient exploration, efficient use of shareholder capital, and importantly, efficient progression and value add in a project. So we've done a lot of work there. You can check out our website. Actually, we have a media page on the Barton Gold website. We actually have a lot of videos that we put together to provide people content so they can actually see what we're doing. They can see where we are, what we're working on. In particular, various of our aerial videos really give people a view of how accessible and open these areas are and just how easy it is to explore, but also to potentially bring these in operation. So there's a lot of information out there. Of course, we'll be out there at other conferences. We think that we've got some very exciting news flow coming up. So this is probably the right time to start doing your research if Barton Gold is of interest to you.
Well, thank you so much, Alex. It's been great hearing about Barton and having you answer those questions in a an understanding of your company, but the gold market as a whole. For the viewers out there, if you have any further questions, feel free to send us an email. If we can't answer them ourselves, we'll reach out to Alex with a couple of them and he can answer them in due time. But thanks everyone for tuning in. We look forward to seeing you at our next webinar.
Thanks for having me.
Thanks, Alex. Have a great one.
Yeah, thanks.